Hello. We are here with Chris Wilkins, the managing partner of Wilkins Southworth, Chartered Certified Accountants, based in Barnes, southwest London. Chris, can you explain the type of work you do from a tax angle and an idea of the clients that you work with?
So Wilkins Southworth, we've been based in our office here for over 30 years, and we do a lot of tax. We do domicile, residence. We've acted for the largest telecommunications business in St. Petersburg, Russia. We've done double taxation treaties with them involved in that. We've acted for the largest landowner in Bucharest, Romania, as well as dealing with current clients who want to be brought into the UK to make them resident, make people not resident. And prior to the 5th of April this year, we were dealing with domicile. So a lot of the tax that is being talked about at the moment has something that's come up on our radar screen in the past and the present.
I see. Today, I'd like to focus on this autumn's budget and to discuss the types of taxes that might be introduced. I find the whole thing quite mind-blowing, and every time I look at my newsfeed, there seems to be another new tax that might be imposed. Can I ask you a comment on the main ones as follows, just down here?
Okay, let's have a look. So you got a lot of here of the sort of the old favourites. So let's start off with number one. Number one, it says the wealth tax. The wealth tax, the figures being bandied around could say that it could raise £4 billion. The trouble with the wealth tax is you've got to bear in mind that this country, about the top 1% of taxpayers pay about 30% of all tax. And as you've found with the domicile tax, if the figures are true, they reckon that about £12.2 billion of tax has left the country because people have moved out of the UK by taking themselves non-resident to avoid the domicile tax. The wealth tax, if it is brought in, may only be payable by about 5,000 people. These 5,000 people are normally quite peripatetic. They've probably got properties around the world, and it may not be too difficult for them to avoid the wealth tax by making themselves non-UK resident. I think in 1990 there was about 12 countries that had the wealth tax. Now there's only about 3. And the thing about the wealth tax is that if you're not in the country and you're not resident, you ain't going to pay it. So people may just leave the country. So if, for the sake of argument, I had a business, and let's say that business was in the UK and I decided that the wealth tax may come in, I may move to France, and France is one of those countries that used to have a wealth tax. They found that it didn't work, so they abolished the wealth tax. Now, therefore, I could perhaps run my UK business from France. I'd be non-UK resident, which means I wouldn't pay income tax in the UK, and I wouldn't be subject to the wealth tax. Now, there's the next question is, what is my business worth? So from that point of view, you could say, well, if I had a fledgling business, how would you value that fledgling business? As an accountant, we see lots of business valuations, and the same business could have a number of different valuations depending on how it's been prepared. So the problem then is, how do you actually value a business? So if I started up my business, say 2 years ago, it might not be making profit. I might leave the UK today, and then the question is, well, if I was hit with a wealth tax today, then I haven't actually got the money to pay the wealth tax because A, the business isn't in profit, and B, I haven't got the cash. So because of that, one of the 3 countries that does have a wealth tax, Spain, specifically doesn't include private companies in their wealth tax valuation. So that's the way they deal with it. The next one is Switzerland, which has a wealth tax, but Switzerland doesn't have a capital gains tax or inheritance tax. So you've got to bear in mind that we have 2 capital taxes in this country. Broadly, capital gains tax, which you pay on assets you dispose of in your lifetime, and inheritance tax is the assets that you own that's subject to tax on your estate upon death. Switzerland has neither of those. And the third one is Norway, and Norway does have capital gains tax. It doesn't have inheritance tax. And when Norway bought it in, a lot of the Norwegian residents left to go to Sweden. So there are a number of things that militate against the wealth tax that means that it might be quite difficult to bring it in, and it may be a non-starter on the basis that we've got 2 capital taxes already. Whilst it's great in theory, I think it might be difficult to bring into practice. You've then got your next number is an exit tax. Exit taxes, by their very nature, means that when you leave the UK, you're going to pay an exit tax. The trouble with exit taxes is if the Chancellor in her autumn statement stood up and said, I'm going to bring an exit tax in on the 6th of April 2026, then anyone that thought they might be making a large capital gain would probably start packing their bags and leave, in which case the exit tax wouldn't affect them. So then the next stage is you've got to bring an exit tax in broadly at midnight the day you announce it, which would be pretty difficult. The reason it would be pretty difficult is a bit like the wealth tax, is that what is your business worth? And when we say what is the business worth, is that if, like I say, I had a fledgling business and that business was 2 years old, if it's a private business, some businesses do well, some don't. There may be an argument that, say, I've got a patent or some great idea or some software today, that may be a great idea, but it doesn't mean to say that my business will have any value, because I may not get the funding to keep that business going, and it may go out of business quite shortly. The main 5 countries that do have an exit tax, so that's Canada, America, Germany, can't remember the other 2, but they will actually, they have what's called a deferral system, and their deferral system then has the ability to tax you when you're out of that country. Now, the problem with the deferral system is that we have a double taxation treaty, and because Britain was a trading nation, a lot of our you'll probably find that our double taxation treaties are wider than any other country in the world. And they started a lot from bartering regimes, and then they evolved into double taxation treaties. So then what we'd have to do is revise the double taxation treaty regime to bring in an exit tax, which would be a mammoth task. So the practicalities of bringing exit tax in, I also think would be very difficult. I'm not saying these aren't impossible, and indeed I read recently that Belgium's just brought in an exit tax, so it may be that the writing's on the wall for an exit tax. It's just that it's going to be very, very difficult to bring in, and I can't really see how they would bring it in without having any advance notice, in which case people may just leave the country. So from that point of view, I think that those 2 taxes, whilst they will bring in a lot of money, potentially, I think it'll be very difficult to do it in practice. You've got a third one there, which is remove capital gains tax on your principal private residence. So that could bring in billions of pounds. The trouble with that is that you could have the effect of historically taxing people. So to give you an example, I've got a client I could think of who's made a capital gain currently on their principal private residence of £342,000. The highest rate of capital gains tax at the moment is 24%. So you could say, well, that's great, we just tax £342,000 at 24%. The only trouble is that person has lived in that property for 60 years. The property costs them £8,000, it's now worth £352,000, therefore they've got a gain of £342,000. But the £342,000 has been built up over 60 years. And in Great Britain, we abolished indexation on capital gains. And the bulk of that gain is due to indexation, not that they've done anything to the property. So you could say that would be particularly pernicious if you're taxing someone for a gain made in the last 60 years and there is no indexation relief available at the rate of 24%. So capital gains tax was brought in this country in 1965 on the 6th of April, and historically we've never taxed principal private residences, and they've always been exempt from tax. And because of that relief, your your sole residence is free from capital gains tax, any other properties would be subject to capital gains tax if there was a gain on them, if you had more than one property. But I think this would be, I would say, a bridge too far, because the UK population has never actually suffered that before, and it would amount to a historical tax. The other thing you've got to bear in mind is, from that point of view, is what would be the net effect of this? Well, if in that particular example where this client's got a property that's valued at £350,000 that they've lived in for 60 years, then they suggest that the actual transactions could reduce by 45%, because people say, okay, I just won't move. I will stay in that property. I won't downsize. So if I'm not downsizing and transactions go down by 45%, then that means that there won't be any stamp duty payable. If, say, they are an elderly couple, they could have gone to a smaller residence, there would have been some stamp duty, some conveyancing fees payable to solicitors, some survey fees, etc., etc. None of that would happen because the property market would stagnate. If it stagnates, you could say, well, okay, well, we will get taxed in the long run. But on £350,000, if that couple had little or no other assets, they wouldn't pay capital gains tax because they'd die owning the property, and they wouldn't pay inheritance tax because it's covered by their inheritance tax exemption. So there wouldn't be any tax payable on that. So then you think, well, wait a minute, you might be cutting your nose off to spite your face, and you'll actually reduce the transactions in the property market, which could have a dire consequence for other reasons. So you've sort of got to think on the long-term aspects of this, so how that would work. You've got another one, number 4. He said increase the highest rate of capital gains tax to the highest rate of income tax. Now, believe it or not, this was done in the past. It was done by Nigel Lawson in 1988, and he increased the rate of capital gains tax, the highest rate, to the highest rate of income tax, and he's increased that to 40%. So at that stage, capital gains tax was levied at a rate of 40%. However, what he did have is he had indexation relief. At the moment, 20 years later, Gordon Brown reduced that from 40% to 18%, but he removed indexation relief. Now you could say, well, how important is indexation relief? So let's give you an idea. If I bought an asset 10 years ago for £100,000, the chances are that that £100,000 is now worth £135,000. If I sold it today for £150,000, I'm going to pay £12,000 capital gains tax. And the reason it's £12,000 is because it's £150,000 minus £100,000, which is the cost, £50,000 times 24%, £12,000. However, my real capital gain is £150,000, my sales price today, less the £100,000 plus indexation makes it £135,000. That's £15,000. So that's nearly 100% capital gains tax. You don't see 100% capital gains tax written anywhere, but that would be the effect of it. So if you did increase the rate of capital gains tax from the highest rate at the moment, 24%, to say the highest rate of income tax, which is 45%, I think you would then need to bring back indexation, and indexation would have a massive effect to swing it the other way. And I wonder then as to what extra tax that would bring in after the indexation relief. So that also would have a detrimental effect to the amount of money you could raise, but I don't think you could raise it to 45% capital gains tax and not give any indexation relief. So again, that one, I think it has its downsides. You got another one, you're saying charge national insurance on rental income. So I think rental income, I think they said that when I did a search, the rental income the profits are about £44 billion. So national insurance 8%, that gives you about £3.2 billion. Well, you could say, well, if national insurance is levied on my salary, it's levied on my self-employed profits, why shouldn't it be levied on rental income? that seems a bit erroneous. Well, what you've got to bear in mind with rental income is what is my rental profit? So in 2016, George Osborne brought in Section 24. Section 24 said that I would not get tax relief on my mortgage interest as an expense in the rental accounts, but as a tax reducer. So to give you an idea, before that legislation was brought in, let's say I had a PAYE salary of £50,000. £50,000 is on the cusp of me paying income tax at 20% or 40%. So let's say then I had rental income of £20,000 and my own expense was mortgage interest of £20,000. So therefore my rental property did not make a profit and my PAYE income was £50,000. So I only paid tax on my PAYE income. After George Osborne's Section 24 had been brought in, the new rule is I pay 40% tax on my £20,000 rental income, but only get 20% tax on my mortgage interest of £20,000, which has the effect of me paying tax at a net rate of 20% on my £20,000, which is a £4,000 tax bill on a rental property that doesn't make a profit. So therefore, what will happen is that if the tax on the national insurance is taxed on rental profits before mortgage interest, then that would be a disadvantage straight away. If the rental profits is taken after deducting mortgage interest, then you have to do a different calculation from income tax, which doesn't make sense. The other thing is that you've got to bear in mind is that rental income is not pensionable income. So therefore, if that £50,000 PAYE income of mine was subject to PAYE, which it is, or if I was self-employed, subject to income tax, which it is, I can pay pension payments and get tax relief on those pension payments based on that. However, I cannot make pension payments based on rental income. Therefore, I can't reduce my rental profits for a pension payment, which also would count against it. So therefore you think, well, that too would not make sense. You've then got one, number 6, tax-free pension lump sum. So at the moment, Jeremy Hunt, the Conservative Chancellor, in March 2024, said that there was no limit to the pension lump sum. So, however, you can claim up to 25% of your pension lump sum tax-free up to a limit of £1,073,100. Let's assume you're lucky enough to have a pension of that much money. That means currently you can take £268,000, which is £1,073,100 times 25% tax-free. The balance of your pension is subject to income tax, and from the 6th of April 2027 it's also going to be subject to inheritance tax. But at the moment you could take that tax-free. If that was abolished, that could raise about £2 billion for the Chancellor, because that tax-free element was probably all going to be taxed at 45%, because the amount would take the person into high rate tax. So that could bring in a lot of money, but she's already had a go at pensions in the October 2024 budget. The question is whether they will come back for another go. Next one you've got is spousal uplift on death. So we've got a client who has a property that they bought 35 years ago in 1990, and the property cost £150,000. Today that property is worth £1.75 million. If the property was gifted to the children today, then capital gains tax will be payable at the highest rate of 24% on the gain of £1.6 million. So that's £1.75 million minus £150,000 times 24%. So that's broadly £400,000. The £400,000 is payable because it's a gift from parent to child. It doesn't matter who you make the gift to, it's still taxable, at the market value of the property. That tax will be payable within 60 days of making the transfer because it's a residential property in the UK. And £400,000 is a lot of money. If that person said, I haven't got that money because there's a dry tax charge because it's a gift, so they wouldn't receive any money because it's a gift. If they said, I'll tell you what we'll do, the estate can worry about it upon my death. Upon death, inheritance tax would be payable at 40% on 1.75 million, which is £700,000. So that's a lot more money, and the reason is because inheritance tax is levied at the market value of the date of death, at a rate of 40%, and no relief is given for the purchase price of the property. So 700,000 as opposed to 400,000 pounds. Now, what if I could tell you that you could get that down to zero if a certain number of circumstances happened at the same time? So let's assume the property is in Dad's name. If Dad died and left that property to his spouse, there's no inheritance tax on assets left to spouse. The property would be left to the spouse. The spouse would then receive the property at the market value at the date of death. And this is where you get the spousal uplift on death. So the spouse would receive the property at a market value of 1.75 million, even though in this example it cost her husband £150,000. The spouse would then immediately give the property to the children. She would not pay capital gains tax because her deemed purchase price is 1.75 million and the value at the date of the gift is 1.75 million. And if she lived a further 7 years, she would not pay inheritance tax either. So the spousal uplift on death is probably raise about £1.6 billion if that was brought into play. So that's big figures as well. Next one is increase in ATED. ATED is annual tax on envelope dwellings. An envelope dwelling is a dwelling owned by a non-natural person, such as limited company, trust, something like that. So you may be aware of my apocryphal conversation with Mick Jagger. And this has been on our website for some time. In fact, most of these ideas have been on our website for some time. So let me tell you about my apocryphal conversation with Mick Jagger. About 10 or 15 years ago, Mick Jagger's house was up for sale in Richmond. And this is when he used to live with Jerry Hall. And I think it was up for sale for about £20 million. So let's assume I did have £20 million, which I don't. And let's assume I had this conversation with Mick Jagger, which I didn't. I would have gone to Mick and said, look, Mick, been around the house, lovely house. I'm happy to pay 20 million. And Mick would turn around to me and say, Chris, to you, 23 million. And I'd say, Mick, what are you talking about? Now, this bit is true. Mick's house was owned by his BVI company. So in those days, the BVI company's stamp duty was at 0.5%. So on the sale of the shares. So because his company owned his house, then you'd pay 0.5% stamp duty. Now, Mick knew that ATED was coming in and ATED would be levied at the rate of 15% in this example by virtue of the value of the property and the fact that I already own the property. So therefore, 15%, 20 million is 3 million, hence how he gets to 23 million. So the government said, look, this is costing us a fortune. So we may as well bring in ATED. And ATED, annual tax on envelope dwellings, means that if you own a property which is owned by a non-natural person, then you'd have to pay ATED if you lived in that property. Even if you don't live in the property and you rent it out, then the limited company has to register for ATED, but there's probably no ATED tax payable. If you live in the property, there is ATED tax payable, but it has been argued that the rates payable under ATED are very low, so therefore they will need increasing. Now, ATED only kicks in for properties that have a market value of £500,000, and it may be that that is reduced. It went originally, when it was brought in, I think it was properties for £2 million, then they reduced it to £1 million, then they reduced it to £500,000, and they might increase the actual rate that people pay it, and also the level that they start paying. So that may be ATED. the last one you've got here is reduce the VAT threshold of £90,000. So the Chancellor said that the government wasn't going to increase tax for working people. If you bear in mind that in the October budget they raised £40 billion, of which £25 billion was raised from employers' NI in October 2024. Now, they said they had about £9 billion spare, but last month the interest rate that was payable on the government bonds is 5.44%, which is higher than the rate even when Liz Truss's government was around. And the government is currently paying over 10 billion, that's with a B, interest per month on its debt. Its debt is nearly 2.8 trillion pounds. Therefore, the government is paying over 110 billion pounds a year in interest. So 9 billion pounds that the Chancellor had saved as of October last year doesn't even cover 1 month's interest bill on the government debt. The trouble with this country is we've got low productivity and low growth. So unless we increase those, we're just not going to get to the figures that the government need. The moment it's predicted that the government needs to raise between probably 10 billion and 50 billion. If you wanted to raise the big billions, the only way to do that is income tax, national insurance or VAT. They bring in about 75% of the tax for this country. And of that, VAT brings in about 15%, is probably 170 billion pounds. Now, the government said they wouldn't increase the rate of VAT. However, one of the things that they could do is they could reduce the VAT threshold. So the VAT threshold for this country is £90,000 per annum. So that means that if I am a self-employed person with, let's say, very little direct costs, let's say I'm an electrician or a plumber where I go and repair things for clients, or I'm a window cleaner, got very little direct costs. If my turnover is less than £90,000 per annum, then that means I don't have to charge my customer, who's probably Joe Public, so they wouldn't be able to recover the VAT anyway. I don't have to charge them VAT. If I'm over that turnover, then I would have to charge VAT, which means that I would be 20% more expensive than my competitors down the road. So I may then make sure that my annual turnover is not more than £90,000. And you could say, well, how generous is that threshold of £90,000? Well, in Spain, the first €1 of turnover is subject to VAT. The rest of Europe, say Germany, Belgium, Netherlands, Portugal, is about €25,000. So our threshold for VAT registration is far higher than most other European countries. So you could say that was reduced to £45,000 per annum, then that means that all those businesses which currently have a turnover of £90,000, just under the VAT threshold, would all have to be VAT registered. And that could bring in a few £billion as well. So it's not impossible that something like that would happen, but the government is looking to raise billions and billions of pounds. So I wouldn't be surprised if a number of these items came up on their radar, and they could well be implemented because the country is so short of money. You just got to bear in mind what effect this tax raising powers will have on the rest of the population. So if that top 1% of taxpayers pay 30% of all tax, so to give you an idea, the Livingstone brothers were paying £104 million in income tax. They left the UK. Now, £104 million of income tax is equivalent to about £21,500 of 21,500 people on the average wage. So that kind of money you're just not going to replace very easily. If you started hitting the top 5% with the wealth tax, the 5,000 people with the wealth tax, and the big taxes, the people who pay the tax may just leave the country. So you've got to be very careful by implementing these taxes, because otherwise things won't add up. So if you think that the average taxpayer receives about £20,000 of benefit each year. £20,000, if you earn, say, £30,000, you're probably going to be paying less than £5,000 tax. You need to earn at least £70,000 to pay £20,000 in tax. So therefore, everyone that earns less than £70,000 per annum is actually a net drawer of benefits from the state rather than is a net beneficiary because of that. So therefore, you need the high rate taxpayers to balance the books, and that's the issue with the country. So that's give you an idea of the top 9 ideas of tax, and I hope that will give you some pointers for what may come up, and I'm not predicting any of this, but what may come up in this autumn's budget. Thank you very much.
Thank you, Chris.